Going to the doctor or dentist is already painful enough, but paying the bill, even with Canada's supposedly free healthcare, that hurts even more. But here's the good news. The CRA lets you claim some of those costs on your taxes. Today I'll walk you through 5 common medical expenses you might not know you can claim to keep more of your money in your pocket. But first, let's go over how medical expense claims work in Canada. Claiming medical expenses in your tax return is a bit tricky, but I'll walk you through it step by step. Plus, I'll show you some smart ways to maximize a refund. The Medical Expense Tax Credit, or the METC, allows Canadians to claim eligible out-of-pocket medical expenses on their tax return. To claim it, you must enter medical expenses on line 33099 or 33199 of your tax return, depending on who the expense is for. If it's for yourself, your spouse or common law partner, or children under 18, you enter it on line 33099. And if it's for other dependents, like adult children, parents, grandparents, or siblings who rely on your support, you must enter it on line 33199. And here's where it gets a little tricky. You can claim only the portion not reimbursed by insurance and must subtract the lower of 3% of your net income, or $2,759. That's for 2024 expenses. I'll show you an example of how that works. Meet Jessica, who earns $50,000 of income and had $2,500 in medical expenses in 2024. 3% of her $50,000 of income is $1,500, so that means her eligible claim is $2,500 minus $1,500. She can claim $1,000 as a non-refundable credit, reducing her taxable income. Later in this video, I'll go over some advanced strategies to help families maximize their medical expense claims. But first, let's break down some common medical expenses you can claim, starting with prescribed drugs and medications. These can be a major expense, but you may be able to recoup some of these costs at tax time. The CRA allows you to claim eligible prescription drugs and medications as medical expenses. These must be prescribed by a licensed medical professional and dispensed by a pharmacist. Over-the-counter medications such as vitamins and supplements, even medical marijuana is covered, but with conditions. You need a valid medical document from a healthcare provider and must purchase it from a licensed producer. So here's an example. Sarah earns $60,000 annually and spends $3,000 on prescribed medications. Her deduction calculation looks like this. 3% of her income, $60,000, is $1,800, so her eligible claim is $3,000 minus $1,800, which is now $1,200. So Sarah can claim $1,200 in medical expenses on her tax return. Keep track of your pharmacy receipts and your prescriptions, which is the key to maximizing your claim. Dental and vision care. For high earners, dental and vision expenses can add up quickly, but many of these costs are tax deductible in Canada. You can claim eligible expenses for services provided by licensed professionals, including dentists, orthodontists, optometrists, and ophthalmologists. Covered expenses include routine checkups, fillings, root canals, gum surgery, braces, and prescription eyewear. However, purely cosmetic procedures such as teeth whitening and non-prescription sunglasses do not qualify. So meet Alex, who's a high earner who makes $150,000 per year. And this year he spent $3,100 on dental work and new prescription glasses. For his dental procedures, he spent $2,500, and his new glasses, he spent $600 for total medical expenses of $3,100. To determine how much he can claim, Alex must subtract the lesser of 3% of his income, which is $150,000 times 3%, which is $4,500, and the set threshold amount for 2024, which is $2,759. Since $2,759 is the lower of those two amounts, Alex subtracts that from his total medical expenses. Therefore, he could claim $3,100 minus $2,759, which is $341. And here's a pro tip. Higher income earners often need larger medical expenses to qualify for a claim, so you can consider timing major procedures within the same 12-month period to maximize deductions. For example, you might consider getting laser eye surgery during the same 12 months where you get a root canal. Before we go to our next expense, if tax savings are on your mind, check out our guide on 7 powerful income splitting strategies to legally reduce your tax bill. Get your free guide on our website. The link is in the description. Medical travel expenses. If you need to travel for medical care, you may be able to claim your travel costs as a medical expense. This applies if you have to travel at least 40 kilometers one way to access medical services not available near your home. If you travel over 80 kilometers, you could also claim meals and accommodations in addition to transportation costs. Eligible travel expenses include public transportation such as bus, train, taxi, flights, or more, and vehicle expenses such as fuel, parking, and maintenance. You could also claim lodging if it's a hotel stay or Airbnb, and meals when it's required for an extended stay. So meet Jennifer, who earns $55,000 and has to travel 100 kilometers round trip for weekly medical treatments over a period of 3 months. And she spends on gas and parking $800, meal and accommodations $1,500, so her total travel expenses is $2,300. To calculate her claim, we'll take 3% of her income of $55,000, which is $1,650, and take her expenses, which is $2,300, and minus that, which equals to $650. So Jennifer can claim $650 of expenses on her tax return. And here's a pro tip: if a medical practitioner certifies that you need assistance while traveling, you could also claim the travel costs for an accompanied person. Keep detailed records of your trips, including receipts and medical appointment confirmations. Private health insurance premiums. If you pay out of pocket for private health insurance, you may be able to deduct the premiums from your taxable income. This includes plans that cover medical, dental, vision, prescription drugs, and hospitalization. However, note that employer-paid premiums do not qualify unless they are included as taxable income on your T4 slip. Premiums for self-employed individuals can also be claimed as long as they cover eligible expenses and are not reimbursed by an employer. Family plans may allow you to claim premiums for your spouse and children, which can help maximize deductions. Meet Mark, who earns $90,000 and pays $3,500 annually for private health insurance. 3% of his income is $2,700, so his eligible claim is $3,500 minus that, which is $800. So Mark can deduct $800 from his taxable income. If you're paying for a mix of private and employer-sponsored insurance, check which portion of your premiums is eligible and make sure you keep records of your payments. Medical devices and equipment. These can be costly, but many of these expenses qualify as tax-deductible medical expenses. You can claim things like wheelchairs, hearing aids, insulin pumps, CPAP machines, prosthetics, and orthopedic braces. And in some cases, home modifications such as wheelchair ramps or stair lifts are also eligible. Some medical devices require a doctor's prescription to qualify, so it's essential to keep a record of both the prescription and the receipt. And if the device requires ongoing maintenance, for example, batteries for hearing aids or CPAP filters, these costs may also be deductible. So here is Emily, who earns $65,000 and buys a CPAP machine for her sleep apnea, which costs $2,500. 3% of her income is $65,000 times 3%, which is $1,950. So her eligible claim is $2,500 minus that amount, which is $550. Emily can claim $550 on her return. While this amount may seem small, combining it with other medical expenses could increase her total deduction. If you're making a large purchase for medical reasons, make sure it's on a CRA's list of eligible medical devices to confirm that it qualifies. Maximizing family medical expense write-offs. If you have a family, properly claiming medical expenses can make a big difference in your tax return. The CRA allows you to combine medical costs for your spouse and dependents, but knowing who should claim them can significantly impact your savings. Let's look at how Richard and Pauline, a Canadian couple with 2 children, optimize their tax returns by making smart choices when filling out their medical expense claims. By choosing the right person to claim, they can reduce their overall tax bill. Richard and Pauline have a 16-year-old daughter, Jen, and a 19-year-old son, Rob. They had medical expenses of Richard had $2,500, Pauline had $2,000, Jen, who's 16, had $1,800, and Rob, who is 19, had $1,300. So for a total, it was $7,600. Since Jen is under 18, her expenses are combined with Richard and Paul's, making $6,300 eligible for line 33099. Rob's expenses must be claimed separately on line 33199. Pauline earns $55,000, so 3% of her $55,000 is $1,650. So her eligible claim is $6,300 minus $1,650, which is $4,650. Richard only earns $42,000, so 3% of his $42,000 is $1,260. So his eligible claim is $6,300 minus that amount, which is $5,040. Since Richard can get the higher claim, he should claim the full amount. So for a pro tip, always check who in your family has the lowest income. They may get a bigger deduction. And by organizing receipts and choosing the right person to claim, you can maximize tax savings when filing your return. Medical expenses, tax deductions, and wealth building strategies all come down to one thing: making smart financial decisions. And at Blueprint Financial, we help you optimize every dollar so you can grow your wealth efficiently. If you want a customized financial plan, visit our website today. And if you love content that helps you keep more money, hit like and subscribe. It really helps support the channel. And thanks for listening.